Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit. Let's first address the latest numbers that have come through from the Association of Mutual Funds in India. The AMFI has released the latest inflow numbers for the month of April. And the total inflows into mutual funds in the period of April has stood at 2.39 lakh crore rupees, and that is a substantial improvement. What you're seeing on the screen is net equity inflows, but the whole number is 2.39 lakh crore rupees there, and it's a significant improvement from the previous month where you saw a significant outflow, and that was largely on account of an outflow in liquid funds. Now let's look at the equity number, because this is also quite significant. 18,917 crore rupees or thereabouts of inflows into actively managed equity mutual fund schemes. You have an inflow of about 18,917 crore rupees of inflows into equity mutual fund schemes, and in that you have an inflow of about 2,200 crore rupees into small cap mutual fund schemes, as well as 1,793 crore rupees of inflows into mid cap mutual fund schemes, which is quite strong. Large cap schemes have seen an inflow of about 350 crore rupees, and multi cap schemes as much as 2,700 crore rupees. Overall, the fixed income space has also seen inflows, and that has seen inflows of about 1.9 lakh crore rupees. This is strong at the start of a new financial year as well. Now, hybrid schemes have seen a substantial inflow as well. That's a number I mistakenly spoke about, 19,862 crore rupees. A bulk of this coming through in the form of arbitrage funds, and perhaps to a certain extent this is because there is a larger interest from the retail segment into arbitrage funds ever since there was a change in the taxation treatment in the fixed income category. This is now being preferred as a short-term category to invest in. Now, a few aspects to pay attention to. First of all, the SIP number looks very strong. The month of April saw SIP inflows of as much as 20,371 crore rupees on a gross basis, and this is an all-time high. The other aspect to focus on is the KYC situation. Now, it was anticipated that this would cause a bit of a problem for the industry as a whole, because a lot of people have reported problems with transacting in mutual fund schemes. If you're unaware of this, what has happened is from the 1st of April, the norms have changed where, depending on the documents that you've used for KYC, you will fall into one of three categories. The first is validated, in which case there's no issue and you can transact as you normally do. The second is registered, in which case there is a requirement for an Aadhaar validation, and in that situation you can continue to transact in the folios that you currently invest in, but no new folios can be invested in. And the third is on hold, in which case you cannot transact. Now, AMFI has actually clarified that as many as 93% of investors fall in the validated or registered category, which means that they can continue to transact. 3% fall in the on hold category, and 4% are those with no KYC. And this is actually something that is borne out in a conversation that I had earlier in the day with the head of a mutual fund, where he said that 97 to 98% of transactions in the space are continuing to go through. Now, that's more or less what the numbers look like in the month gone by, and it looks like a pretty picture. And with that, let me introduce you to what the show is all about. And this is in fact a conversation that my colleague Tamanna Inamdar had, and it's quite an interesting one. They spoke about loan against mutual funds with Raghvendra Nath, who is the managing director of Ladderup Wealth, and Santosh Joseph, who is the founder of Germinate Investor Services. Listen in.
Even as mutual fund investments keep increasing in sheer number and volume, and also become a core part of an average Indian's financial asset and their financial armory, loans against mutual funds are also gaining prominence. Today, we're going to talk about what these are, How do you get them? And is this a good option if you're looking for short-term funding? Now, to speak on some of these factors, I'm joined today by Santosh Joseph, who's founder of Germinate Investor Services, and Raghvendra Nath, who's MD of Ladderup Wealth Management Private Limited. Welcome to both of you, Santosh and Raghvendra. Great to have you on the show. Santosh, let me begin with you and just give us a bit of backdrop and background on loans against mutual funds. Have they become more popular? How are they used? And why are more and more people going for it?
Taman, it's interesting that many of our mutual fund investors don't even know that you have a facility called loan against mutual funds. So therefore, I think this show is going to do a great service for our viewers when they get to know that there is a product like this. That is, you could avail of a loan against a mutual fund. In the past, you must have heard about loan against an FD or loan against assets, but here is loan against mutual fund. Now, interestingly, this product has been there for over 20 years, but many people were not aware of it, and many people didn't know that this was possible. Now, thanks to the growth of the Indian mutual fund industry and the extreme popularity of the mutual fund as an investment vehicle, now even the loan against mutual fund is also growing in awareness, which means that when you have a mutual fund unit or units or a portfolio, and there is a need for you for funds, either for an emergency or for a short-term gap, you don't have to sell these units, but these units are actually pledgeable, can be used as a collateral, borrowed against, repaid back at great convenience. So therefore, the loan against mutual fund is an extremely convenient tool for mutual fund investors to use their investments without disturbing the portfolio, without compromising on selling of the funds to meet short-term or liquidity requirements, and make money work for you while also have the luxury of liquidity at relatively lower cost to the existing loans available. I hope that's a summary of the product.
No, it's a great summary. Raghvendra, let me get you in on why these have, they've been around for a while as a product. Why have they become popular now? And secondly, how does this compare, for example, if you have a quick need of money, to a loan against FD, that question to Raghvendra, or even a personal loan?
Yeah. As Santosh was saying, in any case, this has been around for a very long period of time, and people are now getting more and more aware, and it can be used against any liquidity crunch that individual investors may have. However, the process of taking a loan against mutual fund versus, let's say, you set a loan against FD or let's say a personal loan, is a little more cumbersome process because it requires, let's say somebody has 5 mutual funds and you're taking loan against these 5 funds, then you need to basically go and mark lien against these fund units, and when the loan has been repaid back, then you need to take the NOC from the bank or the NBFC and again go to the mutual funds to unlien these. And during this period of time, you actually lose all liquidity. So if you were to basically wanting to switch from one fund to another, you will not be able to do that when this loan is current, or even a small portion of the loan is current, because those units are already liened or pledged in favor of the bank or the NBFC. So the process is a little cumbersome, and therefore it is suitable more when you have a large need of funds for a longer duration. When you have a small illiquidity or let's say a mismatch in your finances for 1 or 2 months and a small amount, then probably a personal loan or a loan against FD could be better because they are far easier to seek.
Seems like there are quite a few disadvantages as well, and perhaps which is why loan against mutual fund is not that popular. Santosh, if I were to ask you to compare to other options when it comes to a loan against mutual fund versus loan against FD, personal loan, etc., how would you rate that?
Yes, see, there's a reason why they are not popular is because of the way the product is loan is applicable. For example, thanks to the great amount of technology today that's available in credit cards or loans or those quick easy loans today, a personal loan is dispersed in a few minutes if you got a good credit score and you got access to those apps on the banking platforms or the NBFC platforms. Whereas a little bit of a difference in the loan against mutual funds is that you got to mark a lien against the units, and therefore a longish portfolio will take that many more number of liens to be marked. So therefore it easily, on a comparable time basis, one can be done in a few minutes, other one will take at least 2 to 3 business days. Now, on the other hand, when you look at in the mutual fund space also, there is limits that apply. Whereas in a personal loan, if you are looking for a certain particular amount, it's very easy and you just get it. Whereas in mutual funds, different category has got different limits. For example, liquid and fixed income has got a certain percentage margin, equity's got a different percentage margin, and there may be some schemes that you may or may not get even a loan against. So there are these subtle differences, and I think I agree that if this is going to be for short term, then credit cards or personal loans will make a big difference. Where if it's going to be for slightly long term, more strategic in nature, that you have investments, you don't want to disturb it, you want to raise liquidity against your investments without disturbing your investment, then loan against mutual funds become handy. So essentially, it's for a client to manage his cash flows well and bucket it exactly for the cash flow that he needs for.
I also want to understand, let me bring this to Santosh, in terms of interest rates, how does it compare? In what situation should you even look at a loan against mutual funds? And the concern of, what Raghvendra also said, that even if you take a loan for a small portion, that entire investment gets sort of locked up. You can't do anything with it then. Also, what happens if the value, just to add to that, what happens if the value of the underlying units fluctuates a fair bit? Because at the end of the day, they're, mutual fund investments.
Yeah, so there are 2, 3 parts to this. Number one is the category. If you're in fixed income, you get a higher margin, but please remember the interest rate variable becomes very critical, because you know what returns fixed income can give and what interest you're borrowing at. So to be honest, it really doesn't make much of a difference if you're having fixed income and you want to take a loan against it, because there's a very little fine gap between the interests that you pay and the returns that you get, depending on the category of fixed income. Now, some people don't want to break the investment, they don't mind the cost of interest, then it maybe justifies. Now, coming to equity, considering equities are a volatile asset class, the margins are limited. You get maybe at best 55-60% margin on equity funds. And there again, if there's a sharp sudden fall, there will be a margin call. They will ask you to fund the difference in the gap between the fall in the mutual fund value versus the amount you borrowed. Now that apart, the cost of interest that you pay on the loan against mutual funds at sometimes are attractive and lower than what you traditionally pay for personal loans. So is there a clear advantage there? The answer is yes. The second biggest advantage, notwithstanding the cost, is also the utilization. Now, in a personal loan, whether you use little money or more money, once the loan is dispersed, you pay interest on the overall amount. Whereas in loan against mutual funds, by and large, it is an overdraft kind of a product. You pay only on utilization and you pay less based on your repayment. For example, you borrowed 5 lakhs, you paid 2 lakhs, you only have a differential of 3 lakhs, you pay interest only on the outstanding loan amount. So there is a little bit of convenience in the loan against mutual funds in terms of how you are charged in interest, and how when you pay back, there's no penalty to pay back and you only pay for the residual amount. Whereas the interest rate itself can be a little softer than the traditional personal loans.
And just that question to you as well, Raghvendra, is the big problem, apart from the fact that your investment gets stuck while your loan is on, the variance in the value of the units?
Yeah. No, that's right. I think, but generally, when you are looking at when an NBFC is disbursing the loan, they are mindful. And that's why, as Santosh said, that let's say typically, and I've seen that for many clients of ours, whenever we have taken a loan against equity mutual funds, NBFCs don't extend beyond 50%. And I think 50% is good enough for them to cover for any volatility which will happen in the next few months or whatever. So unless there is an extreme event like a global financial crisis, the margin calls may not happen, because NBFCs in any case are very mindful of the risks that they are taking. Okay, so that is not such a big concern. I think where investors can benefit a lot is the lower interest rate, because you can actually negotiate interest rate in loan against mutual funds, because you see it's a secured product. The NBFC can sell your units at any time and recover the money if you don't pay them in time. Okay, so it's a secured product, and because the liquidity of mutual funds is very high, an NBFC will prefer a pledge of units against, let's say, a pledge of a car or a pledge of a house, because selling them is far more difficult than selling a unit. So the rate of interest can be negotiated depending on the quantum and the amount of margin that you are ready to give up. So let's say if you have 50 lakh rupees worth of units and you only want 10 lakh rupees of loan, NBFC will be able to give you a very, very fine interest.
Now, this is my favorite part of the show. If you want to write into us, the numbers on your screen, you can send us a WhatsApp message with all of your details. Our first query today is from Raj, who's aged 54, and the goal is son's retirement. So Raj says he has 2.2 crore rupees invested in mutual funds skewed towards mid and small caps. Says, I can invest 5 lakh rupees a month moving forward for the next 7 years, and then my son can continue until his retirement. What funds can you recommend to us? And of course, they've laid out their current mutual fund investments. So they're in the Quant Small Cap Fund, the Quant Momentum, Quant ELSS, and the Mahindra Manulife Small Cap Fund as well. So a whole host of small cap funds. From what I can see, it's largely small and mid cap funds. There is one retirement saving fund, but and a PSU equity fund, but a whole variety, a long laundry list of funds. Santosh, let me begin with you. First of all, I think it's very interesting that this gentleman wants to plan for his son's retirement already. And then let's come to what...
I won't be the son.
I know, lucky son. But you know, then the question is that first, does he have too many funds and are too many of them small caps?
Well, to begin with, it's a phenomenal idea to be investing for transgenerationally. Typically, we do not have that mindset to be investing for children because, you know, we've done that traditionally with physical assets. Now, the idea is good, but where I'd like to help Mr. Raj get a little perspective is that the list is just too much. It's exhaustive, and this is basically erring on the side of caution. When you know you want to be an investor, when you know the space is small and mid cap, and when you know that it's for your son's retirement, which is really 2-3 decades away from now, most probably, you've gone spray painting all over town. The way to navigate this is just a cursory, preliminary comparing of the schemes to the underlying holdings will help you rejig the portfolio. So begin by condensing the portfolio from this long list of 10, 12 or 15 list of mutual funds to maybe a concise 5-6 list of funds, which are predominantly in the space that the father likes, that is Mr. Raj, so that he can continue that. Why keep adding more money? That, you know, you have a really effective portfolio working for you in the space that you like and for the timeline that you like.
Let me take that question to Raghvendra as well. Would you first look at paring down the kind of funds and move to a bigger variety rather than just this much concentration on small cap and mid cap? What would you suggest to Raj?
So, when I look at Raj's portfolio, actually, I find a little kind of confusion, okay? He is invested into small cap, which is the riskiest category of the market because these companies are small in nature. They have not yet to prove themselves. They are running their businesses for a shorter period of time. The management, quality is still not very clear whether management will be able to scale their businesses to be a mid cap or a large cap subsequently. So they are risky investments. And then he chooses a risky investment and then he's trying to diversify within that, and then he's picked up some 14 or 15 names. And he's planning for a retirement. So he seems to be a cautious man, but doing things in a manner which basically puts his portfolio at a greater risk. And looking at this portfolio, somehow I get a sense, because we don't have Mr. Raj to actually answer, but this portfolio has been created in the last 2-3 years. because this is the time when the small caps have given that 30, 40, 50% returns, and therefore, everybody has get lured to invest more in small caps. And in fact, when I look at the names of the funds that he has chosen, for instance, he has a lot of quant funds, and quant actually started business only in 2020, and which means that he's created his portfolio post 2020. So I would just like to caution him that markets can be extremely volatile, extremely brutal, and we have seen a sample of that in March of 2020 when in a matter of 15 days markets corrected by almost 26%. And so your portfolio has to be geared to withstand that volatility whenever that volatility happens. So you should basically, obviously, as Santosh pointed out, pare down your portfolio. 15 names are not enough, because then you are basically owning the entire market. Okay, a better approach will be to basically just pick up 6, 7 funds and diversify across large cap, mid cap, and small cap. Don't just chase returns, chase stability and growth.
Let me come to Partha Mitra. Partha Mitra's question, who is 56 years and the goal is a retirement fund, asking, is it a good time to start a SIP of 10,000 rupees in HDFC Midcap Opportunities Fund? My investment horizon is 5 years. I am aiming for a 1 crore corpus. I don't know, does the math add up, Santosh? There's 5 years to go, 10,000 rupees a month, and a 1 crore corpus is the goal.
Well, the math won't add up. The thing is that at least one is looking for a 5-year plus time horizon. Now, considering that you're starting at this age in life, what is better is that you stick to the discipline of investing. And there's no harm in a mid-cap fund if you're at least going to stay for 5 years and above. And especially through an SIP route, you largely mitigate the high volatility of the market. But you have to be realistic about this approach. Like I said, the positive is that you want to start an SIP at least now, and you want to be in mid cap, and you're considering it for at least a 5-year horizon. I think you should begin on the journey. Now that 1 crore may take slightly longer period of time, and you may have to expect the market to give you a supernormal return for you to achieve that number. But I think I'd like to encourage the person by saying, good job started, continue with it, and eventually you will also learn to scale up the SIP.
Okay, so, there's a follow-up there. Let me take that to Raghvendra. What is the right age to start building your retirement fund?
Obviously, as early as possible, because the power of compounding only starts working later on. So, for instance, in this case, like in this gentleman's case, if we were to invest for 5 years, 10,000 rupees, he's going to basically invest 6 lakh rupees over the next 5 years. In a reasonable scenario, the 6 lakh will be looks like something like 7.5 lakhs or 8 lakhs. So he hardly sees any returns in the first 5 years. But the moment he starts crossing 15 years and 20 years, then the compounding starts having its impact. And so the earlier you start, the more benefit of compounding do you get, and therefore the larger wealth that you can create for your retirement.
Okay, so that is the plan. When it comes to this viewer's query, but remember, you can send us all of your queries. The numbers are on your screen. That's all the time we have for today, though. Raghvendra and Santosh, always great to have you on the show. Welcome back anytime soon. And to all of our viewers, we'll see you back tomorrow, same time, same place on the Mutual Fund Show. But stay on for now. You have a lot more coming up on the other side on NDTV Profit.